Welcome back. Today we are putting on the tactical strategist helmet. We're going to set aside the usual news headlines and really dig into the market's microstructure. Specifically, what the world's top portfolio managers are looking at in that final hour of trading to set their books for the next day.
That's right. Our mission today, and we'll use the hypothetical closing bell of Monday, December 1st, 2025, is to do a surgical analysis of the SPX and NDX.
Moving beyond just the simple price change.
Way beyond that, we need to identify the true institutional footprint. Was that late action a sign of powerful, deliberate accumulation, or was it something more deceptive, like a quiet distribution? And that distinction, well, it's everything.
Okay, let's unpack this then. Because if you're a sophisticated fund manager, you're not just glancing at the final price. You're trying to figure out conviction.
Exactly.
So the core question is, how do you read that frantic last 30, maybe 60 minutes of trading to really anticipate tomorrow's opening move, December 2nd?
It's the difference between seeing movement and understanding the motivation behind it. We focus rigorously on that closing window.
Because that's when the big orders hit.
That's when the institutional block orders are executed. We have to know if that flow was being successfully absorbed by strong buyers, which is robust accumulation, or if smart money was, aggressively offloading risk, which is distribution.
Okay, so let's start with the bull case. Accumulation. What specific features are you looking for in those final minutes that just scream conviction?
You need really three things to align perfectly. First, price strength has to accelerate into the close.
So not just drifting higher.
No, not at all. It should be pushing decisively toward the intraday high. Second, that move has to be supported by elevated volume. A price spike on high volume means real money is being committed.
And the third piece?
The third piece is confirmation, and that comes from a technical indicator, the accumulation distribution line, the AD line.
And why is that AD line so crucial for validation? Price and volume aren't enough.
Because price strength alone can be misleading. It could just be short covering. But a rising AD line confirms that the majority of trading volume actually happened closer to the security's high for the day. It shows the money flow is genuinely moving into the asset. It validates the whole move.
So that combination, accelerating price, high volume, rising AD, tells you demand just soaked up all available supply right into the bell.
You got it. That's a very strong signal.
Now let's flip that script. The danger signal. Distribution. What does that look like when the big institutions are quietly shedding risk?
It's basically the mirror image. You're looking for price weakness that gets worse into the close, usually on heavy volume, with the indices settling near their daily lows.
Okay, so supply is overwhelming demand.
Right. But what really raises the red flag, the truly ominous signal, is that late price drop combined with a sudden spike in volume.
So the price is falling, and all of a sudden volume just surges.
Yeah.
Why is that specific pattern so, indicative of forced selling?
Because it suggests the long side forces have just decisively lost their conviction. When volume jumps at the low, it often means sellers are hitting the bid hard. The short side forces are gaining control. And that often precedes a flat or, more likely, a lower open the next day.
Right. This is where understanding the flow gets really tactical, I think. Looking for those divergences. For example, if the index is advancing but volume is actually declining, that's a huge structural warning sign.
A huge one, a rally lacking conviction.
Yeah.
When the SPX or NDX are pushing higher into the close but the volume is thinning out, it just signals a reluctance to commit more capital at these higher prices. It means the move might be exhausting itself.
So any selling pressure is going to be met with weak demand.
Exactly. And another critical divergence is when the price makes higher peaks, but that AD line we talked about, it just fails to follow.
So the price is going up, but the underlying money flow metrics are basically flatlining.
Precisely. That suggests the rally is concentrated in just a few names or maybe even being manufactured. It doesn't have that broad institutional support. And that lack of breadth, which I know we'll get to, it means that uptrend is built on a very narrow, very fragile foundation.
That brings us perfectly to our next level of analysis. We've looked at price and volume, the symptom. Now we move to the structural health of the entire market. Let's talk about liquidity and volatility.
Right, because price action is just the surface. What truly determines risk is the underlying plumbing. We have to gauge how much capacity the market has to absorb future shocks, and that always starts with liquidity.
And how do we track that? Deteriorating liquidity isn't as simple as just looking at a price chart.
No, it requires looking at market depth and funding conditions. We track widening bid-ask spreads, especially in the futures complex, and a thinning of market depth. This tells you that fewer participants are willing to commit capital far from the current price. When that cushion disappears, moves get much more violent.
And we have to factor in the current funding environment. Based on some late November 2025 reports, there was some stress showing up. You mentioned overnight funding rates tightening.
Yes. For those who don't follow it closely, we look at indicators like SOFR, the Secured Overnight Financing Rate, and the General Collateral Rate. When these key overnight lending rates, how banks fund themselves daily, start trading above the Fed's upper target, that's a clear signal.
A signal of a cash shortage in the system.
A major one. It suggests an increased reliance on the Fed's standing repo facility. In simple terms, capital is getting scarce and expensive, and that almost always puts a damper on risk appetite in the equity market.
Okay, so liquidity stress feeds directly into volatility stress. This takes us straight to the VIX term structure, probably the most crucial indicator of fear versus complacency.
This is non-negotiable analysis for any PM. In a healthy market, we see what's called normal contango. It's an upward sloping curve. Current near-term vol is low, but the expectation is that volatility will gradually rise further out in time. That's normal. Uncertainty increases over time.
But the major warning siren, the structural flaw that indicates immediate trouble, is backwardation. Can you define that for us in, practical terms?
Backwardation just means the VIX curve is downward sloping. The near-term VIX futures are more expensive than the longer-dated ones.
So people are paying more for protection now than for protection in, say, 3 months.
Exactly. It's like buying flood insurance right after the flood has already started. Traders are scrambling for immediate protection against imminent turbulence.
So if the SPX closes strong on the day, but that VIX curve is inverted in backwardation, you know that rally is inherently fragile.
Absolutely. Because smart money is scrambling to hedge short-term downside. It signals structural fear, and historically it precedes sharp declines. But we can look even closer at vol through what we call correlation breakdown.
Okay.
We saw a fascinating divergence in late November 2025, where S&P 500 index volatility, so the VIX itself, was being sold faster than the volatility of its component stocks, which is VIX EQ.
So VIX versus VIX EQ. Why is that relationship so critical to watch?
Well, VIX XQ measures the implied volatility of the individual stocks inside the index. VIX measures the index's volatility as a single unit. When the VIX is suppressed relative to VIX EQ, it implies the individual stocks are showing more fear than the aggregated index suggests.
Which means the market is moving in unison for some reason.
Correct. It often happens during unstable conditions where the market is moving together due to systematic forces, not fundamentals. Things like liquidity events or forced selling.
A market moving in lockstep is a sign of liquidity issues, not health. This leads us perfectly into the third dimension, market breadth. Because headline index moves can be so misleading.
Oh, they can be. It's the classic case where a handful of mega-cap tech stocks are driving 90% of the index's gain. If you don't check the market's breadth, you are managing your risk based on a total illusion.
So we need to know, is the move broad or is it narrow? How do we measure that conviction using breadth indicators like advancers versus decliners?
For a healthy rally to have any structural integrity, it needs broad participation. We want to see a ratio of at least 2-to-1, ideally 3-to-1, advancers to decliners. A leadership-only rally is just. It's incredibly fragile. The minute those leaders stumble, the whole index can collapse because the rest of the market never even joined the party.
And what's the most alarming divergence you look for when it comes to breadth?
The bearish divergence. That's where the index, let's say the SPX, is making new cycle highs, but the number of stocks making new 52-week highs is actually declining.
Ah, so the rally is dying from within.
It's a classic sign. The pool of strong stocks is shrinking, which means all the risk is getting concentrated right at the top.
This analysis of internal conviction takes us into some slightly more obscure territory now. Dark pool signatures. This is where the big money really hides its intent.
It is. Dark pools are private trading venues where these huge institutional block orders get executed away from public exchanges. It's all about anonymity and minimizing market impact.
Right. So if I'm a trader trying to move $1 billion of SPX components, I don't want to hit the public exchange because it would move the price against me instantly. I'd go to a dark pool.
Exactly. And the major yellow flag we look for, the signature of concern, is increasing dark pool selling or distribution during a public market rally.
That's a huge tell.
It's a massive tell. If the SPX is up 1% on the day, but the biggest institutional order flow is happening on the sell side in the dark pools, that tells you smart money is quietly offloading their positions while retail chases the public price.
It's the classic sign of quiet exhaustion.
Textbook.
This all moves us from forensic analysis to tactical action for tomorrow. We've dissected the close, we've checked the structural health, confirmed the institutional flow. How do we synthesize all this to find asymmetric risk-reward setups for December 2nd?
Okay, so we integrate all those factors into the options positioning landscape. Specifically, we're looking at dealer hedging dynamics. This is where mispriced tail risk often hides. We have to identify the crucial technical levers, things like call walls and put floors, which are based on large open interest strikes.
Let's start with the walls. If a call wall, a big concentration of call option open interest, acts as resistance, what happens if the price actually breaches it?
If you breach a call wall, it can trigger a self-reinforcing move. We call it a gamma squeeze. The dealers who sold those calls are now short gamma. As the price rips above that strike, become increasingly short delta and are forced to buy the underlying index or futures to stay hedged. And their forced buying just accelerates the move higher.
And conversely, I assume, breaching a put floor triggers the opposite,
Yeah.
a negative gamma cascade.
Correct. When the price falls through a big put wall, the dealers who sold those puts become short delta and are forced to sell the underlying, pushing the price down even further. Understanding these flows is critical. They are the fuel for short-term trends.
But the most critical structural concept here for tomorrow's positioning has to be the zero gamma level, or ZGL. This is a price point that literally dictates market behavior.
It really is. The zero gamma level is the price where the overall market gamma exposure shifts from negative to positive. It's the pivot point for all dealer hedging. So if the market is trading below the ZGL, dealers are typically net short gamma.
And when dealers are short gamma, they become trend accelerators. Is that right?
That is precisely right. To remain delta neutral, they are forced to sell into declines and buy into rallies. This reactive hedging is what exacerbates volatility. It creates those violent, self-feeding downward cascades we see. They add fuel to the fire. But if the market is trading above the ZGL, they're long gamma, and they act as dampeners, selling into strength and buying into weakness.
So a decisive break of that ZGL signals a fundamental shift in hedging for the near term.
A massive shift.
That structural analysis of the options market is so powerful. Let's just finally connect this back to cross-asset divergences. Credit markets often sniff out distress before equities do. What's the high-conviction warning signal you're looking for there?
It's the classic divergence. Widening credit spreads while equities are still buoyant. Credit markets are just inherently more forward-looking. They immediately price in default risk and funding costs. So if corporate borrowing costs are rising, meaning the spread between corporate bonds and risk-free treasuries is widening, while the SPX is still cruising higher.
The equity market is mispricing risk.
Demonstrably. That divergence is a highly reliable short signal. It often precedes significant equity weakness.
That is a comprehensive strategic breakdown. So to summarize the key takeaways for you, the listener, understanding the market is not about chasing the loudest headline. It's about meticulously tracking the microstructure, the institutional flow, the fear, and the breadth behind any given move.
Right. The strategic imperative for any portfolio manager is to anticipate forced hedging or capitulation flows. And you do that by monitoring tight liquidity, watching for that backwardation stress in the VIX term structure, and crucially, knowing exactly where that zero gamma level sits relative to the current index price.
So here is the final provocative thought for you to chew on. The next time you see the SPX close strong, don't just celebrate the green number. Ask yourself the critical question. Was that strong close accompanied by broad breadth and confirmed institutional accumulation? Or was it a fragile leadership-only rally that was hiding behind a dangerous VIX backwardation and increasing dark pool distribution? That distinction. Well, that's the difference between simply knowing the price and truly mastering the market.